Welcome back. Or if you're just joining us, welcome to part 2 of our 3-part series on Trump accounts. I'm Julia Fuentes, Vanguard Financial Planning and Coaching Senior Specialist. And today we're diving into the mechanics of how money flows into these accounts, how it grows, and the tax rules that shape outcomes. Joining me again is Joel Dickson, Global Head of Advised Strategies.
Thanks, Julia. Good to be here again, talking some more about Trump accounts. Before we dive into the nitty-gritty details of some of these features that you talked about, I did just want to highlight again what we're overall saying in terms of Trump accounts and where they fit in kind of financial planning for our advisors and their clients. There is a whole host of free money that is out there that the government or philanthropic entities want to give your kids, your clients' kids. Get the account established for any eligible child because you don't want to leave free money on the table. We're going to get into now how does it then fit within the overall broader financial plan and your savings strategies.
Yeah, let's talk a little bit about contributions, contribution limits, like what do we need to know?
So at a high level, there is a $5,000 per year per child limit for Trump account contributions. Of that $5,000, up to $2,500 can be in the form of employer contributions. There are additional contributions like the seed money from the government for newborns or from other philanthropies that have been announced and probably more will be announced. Those are over and above the $5,000 limit. So those don't count towards it. One bit of a nuance though, and what's really kind of interesting, I think is a very nice feature of Trump accounts, is that there is no earned income limit to be eligible to make contributions, and there is no income phase-out limits by which contributions become ineligible, like sometimes they are, like they are with traditional IRAs or Roth IRAs. So anyone can make a contribution for an eligible child up to $5,000 per year, and you don't have to worry about this all phasing out on you.
Nice. For this $1,000 federal seed money, how should advisors explain this to their clients?
Basically, if you have a newborn between January 1st, 2025 and December 31st, 2028, the child is going to be eligible for a $1,000 federal contribution as a starter for these accounts. But you have to go and ask for it. So you do that through Form 4547 and actually make that election. So it doesn't come automatically. Go out and do it.
Yeah, what about employer contributions and family gifting? There's a lot of grandparents that are excited to, hey, I want to give my grandchild this $5,000.
Yeah, so two very different things here. And we kind of know a little bit about both, but we're kind of waiting for more details also on how this is all going to work. On the employer contribution side, a number of employers have already said, hey, we're going to make some employer contributions available. Might be in the form of a match for the federal seed contribution. It might be even separate contributions available. We don't know exactly how this is going to work yet. There's some regulations that we need and some clarification that we need. So we expect to hear more, but certainly advisors should be looking out for their clients. When it comes to others making contributions to the account, parents, grandparents, aunt, uncle, it starts getting complicated. And we fully expect there's going to be some further clarification, but at least the way it looks right now with these accounts is that any contribution other than the child would not satisfy the kind of requirements needed for the annual gift tax exclusion. The $19,000 that you can kind of give without having to report it, it doesn't count against your lifetime gift and estate tax amounts and so forth. At least right now, any contribution would trigger needing to file Form 709, the gift tax form, and would need to be deducted from your lifetime gift and estate amounts. This is obviously a big complication, both in terms of paperwork and legacy planning, and advisors should be aware of that. Again, we hope there is going to be clarification on this point prior to the accounts being eligible for contributions come July 4th of 2026. but it's something to keep an eye on.
Yeah, speaking of taxes, I know as clients come to their advisors to open these accounts, we're going to want to understand basis, non-basis, pro rata rules. Can you comment on that?
Yeah, easiest way to think about this is any individual contributions are made after tax, so that when withdrawals happen, the only thing that is taxed are the earnings on those amounts. All other contributions, employer, government, philanthropic, are made before tax, so that when those amounts are withdrawn, the entire amount, both the contribution and the earnings, are subject to tax. When a withdrawal is made and taxability comes up, then that is done on a pro rata basis of earnings and basis, or in this case, the after-tax contributions that individuals will have made, just like you would normally in a traditional IRA. Mm-hmm. Unlike a traditional IRA, however, if the Trump account is kept separate from other IRAs, withdrawals from the Trump account are not aggregated with other IRAs into determining their tax character. So, you're probably well aware, when somebody withdraws from one IRA and they might be subject to tax on those amounts, they have to look across all of their IRAs and figure out how much is taxable and how much isn't, right? In this case, as long as the Trump account stays on its own, it stands alone from those IRA aggregation rules. One other little nuance. Withdrawals, if they are made from the Trump account, may be subject to kiddie tax. And so, you might think, oh, this is going to be taxed at the child's rate, but if the child is a dependent and would otherwise be subject to the kiddie tax rules, it may be that the taxes would end up on the parent's tax form in some way, shape, or form.
Yeah, that's some good insight. Let's talk a little bit about access and withdrawals and the strategy after the growth period. So how should advisors think about emergency access, Roth conversions, and this kiddie tax that you referenced?
Absolutely. So let's first talk about what the growth period is. So the Trump accounts kind of break the timing, if you will, up of the investments into a growth period and then after the growth period. The growth period is the time from when the account is opened, if you will, for the child until the beginning of the year in which they turn 18. And during that period, essentially all withdrawals are off limits. Once the growth period ends, now the rules are very similar to other IRAs. So you can make withdrawals, they'll be subject potentially to tax and possible penalty if they're not qualified withdrawals. And so you kind of need to take that into account in your overall withdrawal strategy. Included in that would be Roth conversions and whether that makes sense for the child, for long-term financial plan, and so forth. At that point, it would follow the same rules or approaches that any other IRA conversion would do. Now, one little complication would be the impact of the kiddie tax, because now, if the child is a dependent on the parent's return, for example, then some of those earnings and some of that taxability might fall at the parent's tax rate. So again, in all that holistic financial planning, need to think through all of those issues.
Yeah, Joel, thank you for breaking that down all so clearly. So contributions, limits, basis, and strategies for after the child turns 18, that's where advisors can make a significant difference in helping families use these accounts strategically. So in our final video, we'll put it all together and we're going to look at how Trump accounts fit alongside 529s, UTMAs, and Roth IRAs, and how advisors can guide families on when and why to use each. Stay tuned. This is where the planning becomes real.